Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today is August 22nd, 2024, and today on our call we have back the CEO, Owen Moore from BeWhere Holdings. BeWhere trades on the TSX Venture Exchange under the symbol BEW and also trades on the OTC under BEWFF. The company is currently trading at 68 cents with about 87 million shares outstanding, or about a $59 million market cap. I'd now like to hand it over to Paul Andriola.
Yeah, thanks a lot, Trevor. Owen, great to have you back for a bunch of reasons. You're always a great guy to talk to, but more so now today because your stock hit a new 52-week high on the back of some really, really strong numbers for you guys. We've been watching you for quite a while now, so we've been cheering from the sidelines. So happy to see what's been happening and happy to have you back here. We're going to talk about some of the updates, but before we jump into that, Owen, maybe just remind everybody what BeWhere is all about. You've got your presentation up, so I'm just going to hand it over to you.
Okay, thanks, Paul. And it's always good to see you guys. So appreciate talking to you. So we design and manufacture IoT devices and provide software services for clients to view their assets, inventory associated with their assets, and ultimately our goal is to drive operational efficiencies for our clients and end users. We sell through a large, robust distribution network that includes mobile network operators and technology companies. And I'm looking forward to sharing the update. As I mentioned just before we went live, Paul and Trevor, while I'd like to take credit for the share increase, it's not me. We have a wonderful team, group of partners, and extremely supportive shareholders like yourselves. So we appreciate everything you guys have done for the company. So with that, why don't we break right into the deck, and we'll start as usual with a financial update for Q4, and then we'll move into some operational updates, if that sounds okay.
Sounds good.
Okay, great. So total revenue, oh boy. I'm not sure if I'm blocked on yours. Is that a little better? Can you see the whole chart now?
Yeah, looks great. Yeah.
Okay, awesome. So total revenue for Q2 came in at about 4.3 million. It was a 40% increase over the prior year's quarter, which was just under 3.1 million. So we've noticed a little bit of increased growth relative to where we were trending in the past. And 40% is a good number for us. And we hope to be able to continue growth along those lines. If you just kind of extrapolate a little bit, Q3 and Q2 were relatively similar last year, and we got lots of good stuff that we're working on and should be able to continue to improve on these results. Recurring revenue also is seeing a ramp, particularly over the last 2 quarters. We closed Q2 at just shy of 1.7 million in recurring revenue. And I'll remind the listeners that recurring revenue is the high margin side of our business. We run, operating expenses in and around $1 million, with recurring revenue coming in at 1.6 with a decent margin on it. We've reached that sort of inflection point where our recurring revenue is covering our operating expenses. I'm just getting a warning here that my internet connection is unstable, so hopefully it holds up for the next half an hour or so. Yeah, and we expect to see continued improvement in recurring revenue as well. Adjusted EBITDA was a record for us in the most recent quarter, came in at 566,000. What's kind of interesting, our net income before tax came in at about 560,000 as well. So not a lot of difference between EBITDA and net income before tax. The reason we dwell on net income before tax is because while we are in a taxable position producing net income, we have historic losses that we use to offset that tax cash obligation. So that's why we continue to emphasize net income before tax. And I believe we have actually I have a slide that touches on how much reserve we have in that, and we continue to look for ways that we will operate tax efficiently. So we have recently applied for our SR and ED claims, and expect to have a little bit more in the tax bank as we go forward. Net income came in at 387,000. That wasn't a record, but the reason it wasn't a record is because that deferred tax loss we had to recognize in Q4 of 2022, and so that's why you see that anomaly there. EBITDA wasn't anywhere close to that. That was really an accounting adjustment to allow us to realize those historic tax losses so that we're not in a cash taxable position going forward. Outside of that, obviously, EBITDA was a record, and taking away that one-time gain on the deferred tax, it was a record as well. Revenue by category. So this is just kind of summarizing the hardware revenue, the recurring revenue, or product revenue. We don't call it hardware, we call it product revenue, and service revenue. Service revenue is never a big number for us. It usually includes professional services that may be installation related or custom development. And really the metrics to queue on us are both product revenue, which is directly associated to the number of units we sold in a given quarter, and recurring revenue, the high margin side of our business. A couple interesting line items in this chart. Working capital continues to trend upwards. So working capital is the net of your assets and liabilities, and quarter over quarter, about 600,000, I believe, 600,000 it looks like. And that's a number that we watch very closely because we are growing and we consume some cash on a given quarter for inventory purposes and fulfilling orders. We can have a little bit of fluctuation in cash. Obviously, in the most recent quarter, it went up to the tune of 450 or 460,000. But it's the working cap that we keep a very close eye on, and not just for BeWhere, for my own investments in companies that I invest in. It's a metric that I watch very closely. If a company isn't raising any money through issuances of shares, either through warrant exercise or dilution by raising funds, that working capital is a good indicator of how a company is performing. So we watch that very closely. Inventory was up a little bit, but certainly, represents about a half a quarter of hardware. So it's something that we continue to manage very closely. Receivables are up as well, and that's just a function of increased sales, ramping the business. Nothing outstanding that's of concern, so everything's well within range. The deferred tax asset, that's the asset that I mentioned that we took in back in Q4 of 2022. We continue to dwindle that number down as we are in a taxable position. So we currently have about a little over $1 million in deferred tax asset to offset cash on paying taxes for the next few quarters. Probably about, well, I don't want to put a number on it, but it'll cover us for the next couple of quarters. And then we also have applied for additional SR and ED claims to ensure that we can maximize some of our investments in research and development. Devices sold. This is one that I may not have shared much previously, but I thought it would be relevant. Obviously, the biggest chunk of our product sales comes from our MIoT devices. These are our IoT-based cellular trackers. In the most recent quarter, we sold about 23,000 units. That was a record for us on a quarterly basis. And while we were typically kind of in the 16 to 19,000 range historically, we're continuing to see a ramp in product sales, which obviously increases our recurring revenue going forward. And we're proud of that. We've sold just shy of 350,000 devices since inception. And there's probably about 250,000 of those that are live and generating recurring revenue. We do sell devices that will have a one-time use and then no longer be required. And so you do get some natural churn based on that. But by and large, it continues to trend in the right direction. And we're proud of, selling close to 350,000 devices to date. B2B are our old Bluetooth products, and the GT are some Geotab devices that we get involved with, but obviously from the numbers, not to any major extent. So once again, the majority of our revenue comes from the cellular-based IoT devices that we design and manufacture. A quick operational update. So before we get into the meat of it, some of this will be reviewed for the group. About a year ago, we launched our third and fourth generation devices. The first one that came out was the B Mini. This is a Tic Tac size IoT asset tracker packed with a whole bunch of technology, everything from low-powered cellular to GPS to Bluetooth and Wi-Fi, and a whole array of sensors, including temperature, air pressure, humidity, light level. It's been our product that has been driving our bike share programs, where we provide the technology to lift, to track their bikes, but also integrate to the bicycle's control unit. It's called a BCU. In the vehicle world, it's called an ECU, an electronic control unit. In the bicycle world, it's called a BCU. And that allows us to collect all sorts of cool data from the bike, including battery level on e-bikes that helps them determine which bikes to recharge and when. So it allows bike share providers and municipalities in North America and Europe to effectively manage their fleet of bike share bikes and provide some operational improvements. The BSOL, B10, and BeWired are all products that are suited to specific markets in the asset tracking space. The BSOL is the product that we use on dry van trailers. These are your big cube trailers that you see on the road, and this is a solar-powered device that can last for well over 10 years just off regenerating power from the sun, no external wires. And the unique thing about this device is that it allows clients to update their trailer locations every 5 minutes when they're moving, every 12 hours when they're stationary, without the requirement of any external power. So makes the install quite easy, but it still gives relatively robust reporting. Our BeWired product is the product that we use on flatbed trailers. Flatbeds, by their design, don't allow you to mount something that can get sunlight because they put containers on top of the flatbeds. And so you need another device to effectively go after the flatbed market. And we use our BeWired device for that purposes. It's charged when it's plugged into a tractor and being pulled down the road. And then our B10 device is our device that we use for containers, crates, pallets, items that are primarily indoors with zero power. And it uses two AA batteries to provide a device that can update, a couple times a day, but at once a day to last for up to 10 years. So that's our full product SKU, and each of them are suited to specific assets that we focus on. Our distribution clients we're proud of our distribution network. Obviously, well-recognized names that we work with. But one thing that I thought might be interesting to point out to the group is that where our growth is coming. So we engage with our distribution partners in two sort of distinct methods. Either they take the product off the shelf and sell it as a cookie cutter. They just rinse and repeat and sell the device into their clients with the same functionality. That includes our carrier clients, a number of our telematics partners, and other technology partners that we work with. And that really has been the focus of our business for the last 6 years. But as we've evolved over the last 2 years, we are doing a lot of custom development work for our clients that allow us to address very specific use cases in return for large orders. And these are the guys that are actually driving our growth. So The group on the left keeps the lights on for us, and the group on the right are responsible for driving our growth and represent large contracts. I think I've talked about UPS before. We did put an announcement out that we received an order from a transportation company about a month and a half ago. They started with an order for about 7,000 units last year, and they came back with an order for 16,000 units this year. And Brinksguard Loomis is some of the work we do in the armored car space. And then Lift, obviously, I discussed, and Geoforce, I have a slide that I'll touch on as well. Just before I'll repeat some of the work that we've been doing with UPS, and based on the 7,000 units that they installed last year, they realized a 15% gain in operational efficiency. So either having excess product or excess assets that weren't required was not, they weren't able to get the analytics and the insight on that information until they implemented our system. And if you recall, there was a large custom integration that we did for UPS that allowed us to tap into their parts and vendor PO system. And essentially what it does is it allows us to associate a device to a pallet or a container. And then that back-end integration allows us to tell UPS exactly which product and the quantity of product that is on that pallet or container or box. And so that's where we've seen a lot of success. It's a combination of both asset tracking and inventory management, and that's when you start to really get in and understand your client's business processes and understand a 15% operational improvement efficiency for UPS more than covers the cost of implementing this type of system and provides them a lot of value. The other segment of UPS that we've started to work on is in their rental fleet. So during peak season, they bring in rental vehicles. These are vehicles where they're not allowed to install on the OBD2 port or have any sort of wiring into the vehicles, but nevertheless, they need to understand their usage. And so they slap a B10 Plus on the roof. It has more than enough battery power to get them through a few rental seasons. They take them back when they're done with the rental fleet. And this is another area where they've seen strong efficiencies in operations by not requiring as big a fleet as they thought they did require and had been paying for in the past. So this is where we're saving our clients some money. Costco continues to expand. We have two projects. We track their North American fleet of trailers from the supply centers to the point of sale centers. But these are Costco trailers that are owned and operated by Costco, about 6,000 units that we've had up and running with them for a couple of years now, but now they're expanding and using the B-Mini to do yard management. So not all the deliveries that go from a warehouse to a distribution center are done through Costco-owned trailers. They have a number of suppliers, and they want to have visibility into those suppliers when they enter a warehouse facility. And so similar to the rental program with UPS, although it's much shorter term, they will slap a B-Mini with a little magnet on a guest trailer as it comes into the warehouse. And that's providing more unit sales for us to Costco and continues to allow us to evolve our relationship with them. So they've been a great direct client and once again, some customizations with some back-end integrations. Brinksguard and Loomis are our armored car clients. We do use Geotab's base application, and then we write applications specifically for their network communication center over and on top of Geotab. And so the dispatchers log in to Geotab and immediately pull up our screens that allow full visibility and alarming from their entire North American fleet. In the case of all three of them, actually, we do Brinks, every vehicle in Brinks's fleet, both in Canada and the US. As well as Brinks Global and Brinks Armored. They have multiple divisions up and running. And Garda, we do their full Canadian fleet and a portion of the US fleet and continue to expand in the US. So this is an industry that Chris, the co-founder, and myself know very well and have worked in for the last 25 years and continue to push the envelope on technology. It's all automated. So these trucks go into various secure and unsecure modes based on where they're located throughout their travels and throughout their deliveries given on a given day. And so dispatch literally can sit back and watch it. It's got to a point where there's been some comments from some of the management in the armored car industry that we've automated so much that the work that the dispatchers have to do on a daily basis has been reduced significantly. So another great story where we've done some custom work and help our clients work more efficiently. I touched a little bit on Lyft. Excuse me. We continue to expand. We got another 500 units for City of London, UK, just this week, and well over 7,000 units deployed, probably closer to 8,000 or 9,000 units deployed with Lyft. And they continue to light up new cities, and we have a program where we install on the assembly line. So they design and manufacture both the mechanical bikes and the e-bikes, and our devices are installed at the assembly line. But they also have clients who they've sold to historically that don't have tracking, and we have a program to upfit existing fleets. So the combination of new bike builds and existing builds continues to drive good business for us. And GeoForce, one of my favorite telematics companies that we've worked with over the last 3 or 4 years, continues to expand and evolve their working relationship with us. It's very collaborative. We meet with them once a week. I shouldn't say we, my CTO, Alvin, meets with them once a week. We take in their client requirements and co-develop solutions that they turn around and sell to their clients. And so just recently, we've received orders in excess of 12,000 units from them. And a large number of those orders are going to track cable reels. Well, we started with these large metal cable reels. We've started to break into wooden cable reels, which represents about a 7-fold increase to what they've done on the metal cable reels. There's much higher quantities of them. There's some real work behind getting into the wooden reels, and we're active on it right now. But the numbers could easily outsize the 12,000 that they've done on the metal reels. We do need to get the costs of the devices down for it, but it looks like we have a plan to get there, and we're looking forward to launching new product that not only addresses the wooden reel market, but disrupts the price point on solar trackers for our other markets as well. So every time we take on a new SKU to build, we look for sort of quick wins out of it, and that's why GeoForce is so important to us. We have that feedback loop, and if we develop something that gravitates with their clients, it turns into instant revenue. And plus, we know we'll be able to sell that product into other accounts, albeit not for cable reels. And Tenna, another favorite of ours. Tenna is a company out of New Jersey, New York area. They were spun out of a very large construction company called the Conti Group, and we continue to work with them. They have developed a small Bluetooth puck for tracking assets that are smaller. So, if you look below the word Tenna on the right side, tracking everything from helmets to levels to small power tools. And these devices, while they don't connect directly to the internet, they do connect to our trackers that are located throughout their assets. And that data is aggregated in our tracker and sent up to the cloud. So it expands our collective solution with Tenna, and then another group where we have a live feedback and weekly meetings with them to expand the offering and drive innovation. So super happy with the work that we've done with 10. And just this one development project resulted in an order for about 7,000 units and more to come. That's it, guys. Short and sweet today. I hope I covered a lot, but I'd be happy to answer any questions or share any more information.
Absolutely. No, I appreciate it, Owen. And just a reminder, I see some questions have already come in, but for everybody listening, if you've got some questions you wanted me to direct to Owen, just use the chat function and we can get that done. Listen, I mean, some of the orders that you mentioned and even the UPS, how much of that stuff has been recognized in Q2 and how much, if any, do we recognize going forward?
So the UPS order, I think we announced near the end of Q2, and none of that was realized in Q2. So the overwhelming majority of the UPS order will be a Q3 endeavor, with some of it spilling into Q4. They do have a shutdown period where they don't take on any new technology. That usually comes in and around US Thanksgiving. And so those 16,000 units will be delivered between now and their shutdown period, and the overwhelming majority of those coming in Q3.
How about the Geoforce? You just mentioned some Geoforce business as well. Maybe give us a sense of what it looks like in terms of recognizing that. I think you said 12,000 units.
Yeah, so some of the Geoforce did get delivered in Q2. And I think there was a backlog of about 3,000 or 4,000 units that we still need to deliver in Q3. I spoke to Jimmy today. Jimmy McLean is the CEO of Geoforce, and he's super excited about the prospects. So we're expecting to see more orders and more work done with them. It really, I think if we kind of reflect a little bit, the reason we've been successful is our team, obviously, first and foremost, but partners like this, you don't come across often, just straight up people like yourselves that have helped us carry through.
It takes a community to raise a child.
It sure does.
Yeah.
A very patient community, I might add.
And I want to sort of reemphasize this. Like every time you guys get hardware sales, there's obviously, there's recurring revenue that comes with that. So this year, if I did my math right, you see about $2.5 million in product sales. That means you obviously you're going to have a decent increase in recurring revenue going forward every time you get one of these products out there.
Yeah, no, there is typically a delay of anywhere between 1 and 3 months from the time you ship the hardware to the time it's deployed by our partners to end users and billing begins. And that range is anywhere between $1 and $3, depending on the level of service that we're offering. So to give you an example, I think UPS, we're at about 23,000 units now. It's about $1.50 a month in that range. And somewhere around $80 for the hardware. So you can run some pretty quick numbers. And once again, about 1 to 3 months delay from the time you ship to the time you're seeing the recurring jump up.
Yeah.
The more devices we sell, the higher that recurring revenue goes.
Yeah, exactly. And can you give us any kind of sense of what kind of backlog of orders you have that that'll get recognized?
We're north of 40,000. Some of those have specific orders with dates associated with delivery.
Sure. Yeah.
I think if you're modeling us, look for north of 30,000 units for Q3.
Yeah. Okay.
And backlog pushing us into Q4 and Q1.
Yeah. Awesome.
That's new for us too, by the way. Our distribution partners have been good at putting more effort into forecasting and giving us some lead time, and it just removes the surprises and allows us to meet their expectations.
Oh, yeah. And I mean, I remember it used to be a lot lumpier business, but now it seems like the lumpiness is just in one direction.
Yeah. So, it's lumpy's not always a good thing.
Yeah.
And you do look for different methods, either to have that constantly going up or to smooth it out. And one of the things that we've talked about in the past is potentially moving our business model to something that emphasizes recurring revenue over the hardware revenue. And it's something that while we have taken some steps to do it on a small scale, we're continuing to look at that going forward. And if you have a company that's generating 80 to 90% of its revenue through recurring, it's very easy to forecast and project, and it provides that nice smooth trajectory without the lumps. So it's something that we continue to evaluate. There is some cost associated with it, Paul, but we're generating a good amount of cash right now. We're doing it on a trial basis, and as we continue to generate cash, that's money that we can use to tweak our business model a little bit and smooth out some of those lumps and really provide stronger visibility into future quarters.
Well, listen, you sort of answered one of the questions, but I'll sort of say it again. Like you guys are building cash. Clearly, that's a future use for cash. But and mind you, you've been buying back stock as well. Even I noticed like a couple of weeks ago, you bought some more stock back. Is there any other need for cash? Like, what do you do with that excess cash as it grows?
Yeah, I mean, I think our goal is to continue to grow the cash. There's nothing wrong with more cash in the bank. It makes us a more stable company. Our partners do look at our balance sheet, so it's important that we're not leveraged. We don't have debt. We have a decent sized cash position for our size. But if we can grow that cash, I think a relevant use of proceeds is to continue to tweak our business model to drive more revenue to the recurring side. And outside of I mentioned new product development, that's a continual investment. Actually, that's a number, if you look at that year over year, came down significantly. Really what that was about is we launched 3 products last year. And there's costs associated with getting those devices certified, both at the carrier level and at the industry level, PTCRB, FCC, and environmental testing on it as well. And so, as a technology company, you have to continue to invest in R&D. You really only have about a 24 to 36 month window. Whereas if you're not continuing to bring out new products, you'll see things starting to slip. So I think R&D probably first and foremost is a continued investment and tweaking our business model as we move forward a little bit as well.
And I recognize too, like you've got a pretty wide customer base now. I imagine a lot of R&D is at their request. So the larger your breadth of clients, I imagine they're coming to you with problems that they want you to solve. So it's not like you're just coming up with one idea at a time.
Yeah, no, that's huge, right? The scary thing is to bring out a product with none of that feedback loop and hope it works. And in our early days, you had to do that. We just didn't have the relationships, and you have to go on intuition. Obviously, we don't have big budgets to do market research. That's the way the big guys do it, right? They spend a bundle on market research, and they're almost assured whether a product is going to be successful or not. So you have to use some of your experience in the early stages to get stuff out there, and touch wood, it worked out well for us. And now we have this feedback loop. It takes a lot of the risk out of the development, because if you perform and produce the product the client or end user is looking for, then you have instant sales, and then you can also promote that across all the rest of your channels. So that feedback loop. And part of what we're doing from a sales perspective is trying to engage more of those partners that you saw on the left side of the list and move them to the right side. And so not just do quarterly business reviews and roadmap reviews with them, but do weekly development with a potential project that'll come in, once that work is done. So that's sort of a little tweak internally where we're trying to move more to some of these custom solutions. And you still have to be careful. Like even some of the work we did for UPS isn't going to directly translate to something that we do for Costco, because they'll have a different CRM system, and
Sure.
they'll have different methods of integrating. But it's understanding the business process that you can repeat, and as long as you're willing to roll up your sleeves and do the work, it can work out for you.
Mm-hmm. Oh, fantastic. Okay, listen, we're going to take some questions from the audience here, and I mean, I've got a couple right at the top, not even questions. They just want to congratulate you on strong performance here.
Not me, but thank you.
Yeah. Okay, so questioning from Paul, it says, do you foresee the profit margin remaining similar to this quarter, or for it to go back to that of prior quarters?
So profit margin, earnings margin came in, actually, earnings and income before tax came in almost identical, right around 13. I think 12.9 was income before tax, and EBITDA was like 13.1 or something like that. That's a number that if we can keep our expenses flat and increase our sales, we should be able to flow more money to the bottom line. I think the difference in our expenses between Q2 last year and Q2 this year was only a couple $1,000. And that's why we saw the profit margin go up. So there is a balance. I mean, we can't continue to grow forever at this rate and not increase our staffing levels. There's just a natural need for more people to support the growing business. But the trick is to grow that revenue and grow that gross profit much faster than your expenses. And I think we can actually improve on that. It'll be interesting to see how that works out in Q3 and Q4.
Yeah, and again, your product sales, the margins on your product sales are significantly lower than your recurring revenue. So as it's a bit of a, in the short term, the more product sales you have, the weaker your margins are, but it foretells, stronger margins down the road. So it's a
it really is interesting, Paul. One of the things that I used to say to people is that on a good quarter, your percent of recurring revenue is lower, and it's counterintuitive, but it's just because the hardware can create some lumpiness. Now, it does flow through. It takes anywhere between a month and a quarter to flow through.
Yeah, exactly. Okay, so Paul's got another question. It says, is the hiring of Andrew, he doesn't have the family name, going to improve the growth rate? So
family, Andrew Parker, I think he's referring
most
to.
likely, yeah.
So Andrew's his first name. So Andrew is an industry veteran marketer. He worked for the GSMA, who puts on Mobile World Congress in Barcelona. Well, they put on Mobile World Congress everywhere, but the one in Barcelona is the showcase trade show. He's got a ton of experience, and marketing is something that we have to invest in more, and he's already paying dividends to us. He takes things on his own. He's done a great job in getting us a good deal for Mobile World Congress, both for Las Vegas and Barcelona, and we're expecting to get a lot of attention. And so while it might not generate a direct sale, it all contributes to and the other thing that we like about Andrew is he's UK based, and we do need some more European exposure. Right now, the overwhelming majority of our revenue comes from the US, and there's a big open market in the EU that we should be getting after. And so his relationships with the telcos through his work experience is going to be invaluable, and that can potentially drive a large European partner for us as we move forward. But we're super excited to be working with them.
Right on. And then last question, Paul, it says, how active do you forecast to remain in the NCIB? Like I said, you bought back some stock recently. Just give us your mindset in terms of the NCIB.
We're going to continue to leverage it when we see opportunities. It's we were certainly more aggressive in the 20 to 30 cent range, as the stock ran a little bit, we decided to get a little bit more patient to see if like you all, you want a good deal on the stock, whether you're buying it to cancel it or not. So we did tap back in and bought a little bit a few weeks ago, and we're going to continue to be active, but perhaps a little bit more selective than we have when the stock was down a little bit more.
Gotcha. Okay, Cocoon asked a question that we sort of touched on, but how soon can we expect the leasing model to start? When, like, is there a dollar figure or some other metric investors can sort of pay attention to say, okay, we're getting close?
Yeah, so we estimate that to do a full-blown leasing model across the board, every product, every SKU, no options to purchase the hardware up front, would require about $6 million. And you don't spend that $6 million on day one. It's something that you churn through as you put out product, and it starts to pay itself off. You basically need about a year and a half on a 3-year lease. You need a year and a half of a device sale cash to be able to support it. But having said that, we've started to dip our toes in it. We've worked with specific partners like AT&T and Bell to introduce the leasing model on certain SKUs. And we think we can reduce that cash burden through lowering the BOM cost of our devices. So one of the efforts that we have that I mentioned that's associated with Geoforce has some natural pressures to get the BOM cost down to go after a lower cost asset to track. But that can translate into something on the order of $3.5 million rather than $6 million if we cut our BOM cost in half at the same unit sale level. So that I hope I'm not dancing around your question, Cocoon. It's something that we have deployed and want to do more of it, but we want to build the cash through operations to be able to fund that. We don't want to take loans. The lease rate is ridiculous, and we have no interest in diluting the stock. So that leaves us with the option of generating more cash to implement that model.
Yeah, investors always like to hear that you're not interested in issuing more shares. So happy to hear that. For sure.
I did that once, Paul. I didn't have a lot of fun.
I know there was a hangover for a while. No, I know.
Yeah, it sure was.
Yeah. Okay. Deep asks, what's the maximum capacity currently for the company in terms of manufacturing unit per quarter? As you've mentioned previously, you were fully booked. So is there room for growth internally to go above 25K units per quarter?
Yeah, that's a good question. So keep in mind, we do all the design work, we own all the IP around our products, but we outsource the contract and we contract manufacture the product. So the ability to scale, and often we're shipping the product directly from our contract manufacturer to our partners. So that's one of the reasons we've been able to do so much with such a small team. We focus on the engineering, and we outsource things like contract. Now, I've ran companies in the past that had a pick and place machine in the basement, and it was an absolute disaster. There's no reason to take on that effort internally. So it's a function of our contract manufacturer. When we started, we probably represented about 10% of his business. We're probably up closer to 30 to 35% of his business. He's telling us he's scaling up to manage our growth. But there are other contract manufacturers that you can move business to. And we do have some on backup here in North America in case there is a choking point with the Asian contract manufacturers. The problem with North American manufacturing is it comes at a cost. You're looking at about, and the interesting thing is a lot of people say it's labor. It's not labor. There's a different price to components in the Asian market than there is in Canada. I can't buy the components at the same price that my contract manufacturer is buying them for overseas. And there is obviously a labor savings as well, but the majority of that 25 to 30% increase is component costs.
Wow.
So, yeah, it's not scaling because we do outsource the manufacturing of the devices isn't a roadblock for us.
That's not the pinch point. Yeah, I got you. Yeah. Okay, so Jesus asks, what recurrent revenue percentage do you expect to achieve once the leasing model is implemented? And do you think you can get to 100%, or is
well,
not in the short term for sure?
Yeah, I mean, you can point to companies that have done that, and what you don't. So Your clients will have operational budget or they'll have capital budget. And right now we require them to have both. If they only had operational budget, they're going to look to go somewhere else because they can't afford to pay the capital. So that's, you know, there are companies that it's 100% recurring. I can point you to Samsara, their symbol is IoT. Obviously, you know, they've raised billions of dollars over their history to be able to support that model, and it's paying dividends for them now. So that's a model that we want to replicate. Can we get to 100%? You know, probably not right away. I don't think we would say no to somebody who's an existing client that said, you know, we don't want that model. I don't think that would be a smart move, but you know, I think we could definitely get to that 60 or 70% range if we put a wholehearted effort into it. And that's you know, right now, you know, 4.3 million, 1.6 in recurring. You know, we're down around 35%.
Yeah,
in that range.
Yeah, no, that's perfect. Again, Cocoon, he's asking, is the recurring revenue charged for devices that are not in use 12 months out of the year?
Oh, we do have some seasonal stuff. Yeah.
Okay. Yeah.
Yeah, that's on specific clients that are seasonal operations. We will have devices that turn off and get lit back up.
Right. So yeah, it's all managed and
yeah, it's not a big chunk of our. You won't see those fluctuations because the growth in recurring always supersedes whatever units might be turned down for the down season. So you actually don't see those fluctuations show up in our recurring. If it was a big number, you would see our recurring go up and down, but it's pretty straight line.
Right. Yeah, it's been pretty steady. Okay, Jesus, we've sort of touched on this earlier. What's the current backlog and the average lead time to convert them into sales? Maybe that's the question, really.
Yeah, the average lead. So backlog represents orders on hand. So it's not really a matter of converting it into sales. It's a matter of delivering. And delivering, you know, sometimes they're on us to get it out right away, and other times, as I mentioned, our partners are doing a better job of forecasting us and giving us dates to deliver against their orders. So in our backlog, it's not a funnel. You know, that 40,000 units that I talked to are existing orders on hand that we need to fulfill, but may have some dates associated with it.
Is it safe to say, like within 6 months, stuff like that gets executed, or is?
Yeah, I don't think we have any. We wouldn't have any backlog orders that would exceed past Q1.
Okay, gotcha. Perfect. Okay, how long does it take to manufacture the product? If you get a large order, what's the typical turnaround?
Yeah, we tell our clients 6 weeks on an order. You know, we do keep inventory on hand. You saw the close to $1 million in inventory that we keep on hand, but for a large order of somewhere, you know, 3,000-4,000 units or above, it's always 6 weeks is the time frame we give them, and we'll often deliver in 4 weeks, you know, just depending on where we're at with production cycles.
Okay, so 4 weeks. Russell asked, are you working on any R&D aside from custom orders? Is there any magically super new product you're working on?
Yeah, so you know, when we do R&D from a device perspective, not R&D in firmware or R&D on the application or back-end integrations or the platform, but R&D at the device level, as I mentioned, the key is to try and engage with your clients so that you have an instant win for what you're developing, and then make sure it can be applicable to other partners, but maybe not in the identical industry. You know, you don't want to work with a client and then turn around and open up a whole bunch of competitors with that same product. And if he's kind of stepped up and given you orders and insight into what you need to do, you want to do as best you can to insulate that market for that particular partner. Nevertheless, you know, something that might work in oil and gas should work in construction. And we have other partners that focus on construction or just as an example, government would be another example. So that, yeah, it's, The R&D we do at the device level, we do at the firmware level, and then platform and back-end integrations. And we actually don't charge a lot for either firmware or platform or back-end integrations. That work effort is associated with an order for devices, typically how we do it.
Gotcha. Quick question, where's your manufacturer located? Where's your contract manufacturer
Shenzhen.
based?
Yeah, Shenzhen. That's
Shenzhen.
that's the industry hub of China.
Gotcha. Then Hassan says, what do you see in the future in terms of new sensors in a device or new devices maybe? Like maybe
Yeah, that's a good
where's
question.
technology going?
Yeah. So, the reason we're incorporating communication technologies over and above cellular, so Wi-Fi and low energy Bluetooth, is so that you have that ability to do remote wireless sensors that are used for a variety of purposes. Those, even though the device has an embedded temperature sensor, you might want a remote wireless sensor communicating to it. And obviously what we talked about with Tenna, with their puck to track smaller tools and equipment is sort of another example. So if you get the architecture right and then it's expandable, either from a wireless perspective, or you might look to put certain communication buses that are wired inside the device. So for example, to integrate with the BCUs, that's a wired connection. In the past, it's serial, but it's moving to CAN bus, just like you see in vehicles. And so as long as you architect from the beginning to be able to support some new features going forward, it puts you in a lot better position than having to go back to the drawing board every time. So we are doing wireless door sensors. We did the Tenna puck. Those are examples of Bluetooth sensors. And temperature sensors, cargo sensors, wireless cameras. These are all examples of additional functionality that can be based on the core architecture of our current offering. But that's definitely a good, insightful question. Yeah.
Gotcha. Okay, Russell asked, do you foresee a timeline to enter the EU? I mean, you're already in the EU.
We're there. Yeah, we're there. We're just not.
Yeah.
We need to do more.
Okay.
Yeah, and so Andrew, certainly, I touched a little bit on that. I think, some effort towards a large EU mobile network operator could pay dividends for us. So we're starting, that effort and finding the right partner. The challenge with doing anything direct overseas is you have language barriers in certain countries. You have different customs that we might not be used to. So, if you're lighting up employees in France, you certainly need to be concerned about employee rights, which may be different than what we see here in North America. And so for that reason, we want to take our time and find the right partner to help us break into the market and potentially even use them to use level 2 support. So right now, our distribution partners do level 1 support. We take on level 2 support, but if you can train an engineering team or a group within an organization to do that, then it takes even more work off of our hands.
Gotcha. I can take this one last question, and then we'll start to wrap up here. Paulo asks, and I think we've asked you this a few times, but is anybody expressed interest in buying the company? And do you see that as sort of the long-term, call it exit strategy or plan for the business?
Yeah. I mean, listen, we're public, so we're for sale.
Always for sale.
Every day, people are casting a vote either for or against the management. As an ultimate exit strategy, that's been my experience. As you grow it to a certain level. I think in the past I've said, our thought process was to get this to about 20 million in revenues, and then look at what our options are, and whether we want to double down and try and get it to 50, or if there's a strategic buyer out there that's willing to make all our shareholders happy, then we're not gonna turn a blind eye to it. So we do, Paulo, get interest in the form of emails and phone calls. even if it's not to buy the whole thing, to invest in the company, we have a very standard response to them where we try and send them to the market. I mean, we're not looking for a strategic investor or an exit plan, but if it happens and it makes our shareholders happy, then we're not going to shy away from it.
So be it. Yeah,
Yeah.
perfect. Lots of good things have happened here in the last little while. What new challenges, if any, are you facing right now running the business?
Yeah, that's a good question. Less concerns than I've had in the past. We used to go into a quarter with zero backlog, and having a nice solid backlog certainly takes some of the headaches away. I think I touched a little bit on it. We think that the growth has been from our partners where we do custom work in return for a large order. That's something that we think about constantly, and how can we convert some of our existing channels over to that model, and how we can have new partners come on and move directly into that model. And we do have a couple new significant partners that we're working on lighting up, and while it would be nice to move them to that customization model right out of the gate, you need to let them get their feet wet and get experience, and then naturally those opportunities will flow up. So the job right now is to let them know that we're open to that type of working relationship, and if something significant comes up that isn't off the shelf, don't be shy to let us know. So I think converting into more of that model that has large orders and customizations behind it is a heavy focus for us right now. I wouldn't say it's keeping us up at night, but we are going to have to add staff as we continue to grow, and making sure there's a talent pool out there that you can access is important. Mississauga is not bad, but it's certainly not the technology hub of Canada. So, but nor do they need to be in Mississauga anymore. Right? For years I railed against the whole work from home thing. But now I'm starting to embrace it a little bit, and I actually feel more efficient, Paul. So
I hear you. I'm reading the same playbook for sure.
That's one area where I've been humbled a little bit.
Yeah, I gotcha. Okay, so last couple of things is just as always, we're investors, we're paying attention to what you're doing. What do you think we should continue to pay the most attention to, and maybe what kind of catalysts or metrics do you think we need to watch?
The one metric and while we don't come out and say it in the press release, we do talk about the rule of 40 without saying the rule of 40. And we like that one because it's what we think about. We want to grow, but we want to grow profitably.
Yeah.
And that metric is the reason you track that metric, it's really a metric for SaaS companies.
Yeah.
And what it says is that companies that have an earnings percentage plus your year-over-year growth percentage exceed 40, then you should be receiving the higher valuations relative to peers that aren't receiving that. And so we like it because it's something that we've been focused on for a long time, and it's becoming more of a fad to track that rule of 40. And so if you think about it, Paul, if companies, technology companies, and these are companies that are much bigger than us, and I know we're not at their scale, but if they're getting a 20 to 30 times PE, and we're exceeding the rule of 40, then we feel that we should be justified, closer to that 30 times than the 20 times, which is a big number. And so we track that very closely. I believe it came in at 53, 13% earnings percentage in the current quarter, and 40% year-over-year growth, equals 53. So we've exceeded it, and it's it gets harder to do it as you come from a higher base, but we seem to be performing better. So, against that rule of 40, we've been doing better now than we have in the past. So that's a key one. Now, all the typical metrics too, right? Cash flow, working cap, recurring revenue, all margins, all of those are percentage, but are important. But the rule of 40 is one that we've really gravitated to in the last year.
Well, I mean, speaking of that sort of stuff, what really impresses me is that if anything, we've seen an acceleration of your rate of growth here over the last few years. So you're actually, if I remember, this is one of the fastest growing quarters you've had in a long time. And but when I do my back of the napkin math on your backlog, it looks like it's not slowing down for the right now.
You know, touch wood. With any luck, we're going to be able to continue to see that growth expansion happen quicker than we've seen it happen in the past. Yeah, we're excited.
Owen, I mean, this has been great. Is there anything we missed? Is there any key message you want to make sure everybody walks away with today?
No, just once again, Paul, we, you know, you and Trevor and your group have been awesome to us. It's humbling. That's it.
Well, listen, you keep doing what you're doing. We will keep doing what we're doing. It's very, very mutual relationship here. So we're ecstatic that we could be part of this. Very impressed with what you've done. I've seen nothing but congratulations from some of the audience here and their comments.
Right,
I reiterate that. Yeah, congratulations on a spectacular quarter. It's a fun ride. You know, happy to have you here, and certainly look forward to getting you back here whenever it makes sense to get you back here. And we're going to see you, mind you, we're going to see you at the conference. So for those that are coming to the conference, you'll be able to shake and hopefully buy Owen a beer or something when you get a chance.
Well, I'm not a big drinker, but we'll
a coffee. We'll get you a coffee and a donut. Yeah,
a coffee and a donut. Yeah, no, I'm looking forward to coming out. I've recently got into mountain biking for the first time in 15 years, and I'm actually tempted to get on the trails, but I think I might do it after the conference, just in case.
We don't want you to show up in a sling.
Sideways. So no, we're looking forward to coming out and seeing you. It's going to be
awesome. Well, listen, thank you again.
Results are end of November, Paul. That's the next time we're reporting. So.
Okay, perfect. Well, we'll certainly catch you then as well. But say thanks to the whole team. Great job, and look forward to the next time we can chat.
Awesome. Thanks, guys.
Okay, thanks, Owen. Bye now.